Well, hello guys, and glad to have you on board again. Today we're going to do something a little bit special, not an educational trading lesson today. We're going to be talking about a topic that I care about, and most importantly, I'm going public with these because I think this is a question that a lot of people might be wondering, and I've seen some very both partial and weighted beliefs out there. So that's the thing I wanted to uncover and go down the rabbit hole in which talking about Ethereum 2.0 stacking and the Bitcoin chain. I'm not going to go down the technicals. I think there are way too many videos available out there talking about this thing specifically, and they will do it much better than I do. To have specified those things and try them personally, this is not that complicated, of course. It can totally be doable. Of course, there are plenty of very well done tutorials out there. So many people have been talking about the risk management, and that is what we're going to be talking about today. And from what I've seen so far, like I said, either very partial information has been spread out, not to even say some people just spread some bullshit out there. So I just wanted to clear things out. This is my job. I am a professional risk manager, so I know what the fuck I'm talking about. And as I am personally concerned about the fact of whether or not I'm going to stack Ethereums to get yieldings, I will try to give you my answer to this, okay? So of course, this is not an advice and stuff like that. I'll just explain how I do things and the way you should think about it if you intend to do it as well. So first of all, the outcome we're going to get to, without spoiling the conclusion, is if you think you want to do it, you really would like to do it. It's definitely out of balance. Some people are just trying to undermine and say you shouldn't think about it. It's really stupid. If you want it, do it. It's just, once again, not about that. The outcome is definitely not going to be a binary choice on whether you should or shouldn't do it. There are some limitations, of course, and some personal profiles that will not be suitable for it. And that mostly are going to be the one that will not be able to maintain sustainable yielding against the costs, because there will be costs. And so there are some things that they will be totally incompatible with doing stacking at home. That doesn't mean you can't do it in a pool, and that is something else that we're not going to be talking about today. We're going to talk about this eventually on some specific cases, but we're not going to be talking about pools. We're just going to consider pools as a flat consumptions of your rewards. And of course, as we've seen so far, some of the pools can take from 10% over 20, and of course 20 is totally not worth it. 10% could worth it. If you go below 10%, once again, just make sure that the services provided worth it, which means just make sure that if it is cheaper than the competitors, there is probably a reason for that, and you might really want to learn what that is, okay? Though, despite that, we're going to go straight into a PowerPoint support in here to highlight the different variables we're going to be talking about today in order to more precisely assess how oscillating the risk management is and how to properly cover from this. Because there's so much bullshit out there regarding this that really I thought about doing it at least the best possible way. Let's switch to this. Okay, so we're going to use a chart in here. This is a clearly abstract representation of things. It's just used as a support so that the arguments we're going to be showing out there are much understandable for you guys. Okay, so starting first with the first and most impactful variable out there, the yield through time. Of course, I bet you've already seen the curve, so I'm going to go straight through it. Okay, this is, of course, a reduction parabolic curve that tends to head towards some more or less 4% yield over time if we expect the market to go to some recent and to some decent level of validators versus users. Okay, so I tend over the long term an average 4% yield when the system gets fully functional and stuff like that. What we care about is not this part of it, because the major concerns I've seen out there, which is once again total bullshit and absolute proof of amateurism for those who said you're locked for 2 years, so you take a shitty, quite a shitty binary risk in which if it works, you're going to be nice. If it doesn't, you're going to be broken. Damn it, that's much more complicated than that, and really absolutely not that simple. So you might be locked for 2 years, and definitely that is the type of risk we're going to have to manage. But at every problem is a solution, and that is what we're going to be talking about today. So that's the first part of concern. And of course, the second one, which is the one most people get to not talk about, which is totally stupid, the risk of complications to what fully functional blockchain. So as we get to a transition and multiple phases and stuff like that, in here, I'm going to use a statistical representation of transitional risks. So in here, once again, don't get me wrong, this is a projection of statistical advantage we can use out of anything that gets to transition toward another thing, or a more evolved version. Going from version 1 to version 2, basically, there is some kind of a pattern with the risk. And this pattern is oscillating both time and amplitude. And I'll give you a very simple representation of it to make it simple. Of course, it's not that easy, but like you said, risk management is about optimizing the risk, not predicting the future. So that doesn't mean this is exactly what will happen, just means that we have timings to exploit for our personal risk management. The first things I've got in here is a representation of it. Normally, a statistical representation just dampens through time and oscillates. And we also assess, statistically speaking, that the closer we get to the deadline, the longer the amplitude. So it starts pretty rapidly oscillating across phases of risks, and we'll see that depending on how long the transition phase is expected to be, we generally tend to have slower paces and lower amplitudes of risk measurements. So of course, the higher the risk at the beginning, and the oscillation can be quite steep and fast. Though in here, I made the calculations for you to make it easy and to make it more somehow memorizable. So out of a 2-year transition, which is the expectable thing for Ethereum 2.0, it can go faster, it can go longer, God knows, but we're going to take the average so-called consensus out there, okay? So for 2 years, we're going to have approximately 4 types of risks that can manifest through time. The first one being few days after the initiation, and we'll see, of course, if there are shit tons of problems in the code, if the blockchain works or not, if there are some underlying issues. Generally, those hot fixes tend to come few days after the blockchain introduction. So, the transition introduction. So I expect problems. That doesn't mean they will happen because, of course, if a risk doesn't show up, that means price will significantly vary accordingly. So it's just that we're going to have to manage that risk because we don't know the outcome. So we're going to risk manage the probabilities of problem. And therefore, the probabilities of big troubles are definitely at its highest when the thing comes up. And that is for the first 72 hours specifically in our case. So over the first 72 hours, if there's no troubles, of course, risk is going to start decreasing pretty rapidly. Because if we don't see shit over the first 72 hours, that means, oh, damn, that is not that bad. They've been preparing a lot for this. But of course, there are still some underlying possible risks. Okay, so 72 hours is the first big level of risk, which means if I'm willing to take that risk or not depends not on the risk itself, because I don't know shit about whether there will be bugs or not, or it will be fully functional by the beginning and the problem might be showing later down the road. I care about how much I get for this risk, because that's what a risk manager does. I measure the risk. In here, I don't know shit because it's the highest level of possible risk taking, though I want quite some good yields. So am I going to go in by the first day? Am I already in staking pools? Definitely fucking not. And am I going to go for stacking my personal node within the first 72 hours? God fuck no, I'm not going to do it. My first question is, am I going to do it after the first 72 hours where the risk is at its highest? If things just do well after the first 72 hours, I'm definitely going to get in. Okay? And in order to do so, I assess personally that within the math, I'm not going down the math, I've done it, but all right, let's just take it for granted or an average. I want an approximate 15% yield 72 hours after the launch, otherwise I'm not going to get in. If my reward is less than 15%, I'm not getting in. I'm just going to wait for the second node in here, waiting for these risks to show up, see how they reward me, and when I see a match, I'll get in. So that's the first variable I hear. When am I going to get in is a choice. I don't want to be in for the 72 first hours, and then if things do well or not too bad, we've got rapid hotfix and things tend to do not that bad, I'll get in if I have a 15% reward. Otherwise, I'm not willing to take the initial risk, and I'm going to wait for the second appropriate timing, which is generally surrounding approximately 3 months when we care about 2 years time scale. So over 3 months, approximately, the second risk management is going to come. Like, it's more like the underlying problems we've never seen in the first ignition phase and somehow emerge over time. So these problems will literally emerge. But even if they don't, what we care about in here is that we're going to have to cover for the anticipations, because the risk can either show up or not show up. Think about the Schrödinger cat's box. That's how traders think about the market. We don't know shit about how much the risk is willing to appear or do not, but we're going to have to cover for this because, like we said, we're locked in. We cannot sell the Ethereums we've put it into the stacking pool. So at that point, we're going to have to short sell. We're going to have to cover for the potential risk of losses that we could make on Ethereum's prices. That's absolutely the only possible way to risk limits, because when you're in, you can go out, though you're going to have to short sell. And that is something you're going to understand. That's what professionals are going to be doing. That's what every professional is going to do out there. So if you really was wondering what the hell is going on, is the smart money going to go in or out? They're definitely going to go in, but they will do it smartly. They will risk manage each and every one of those portions, because that's exactly my fucking job. Okay? So at that point, 3 months is going to be a portion of risk. And of course, speculators will anticipate that timing. So we should get a timing to risk limits our trades few days or weeks before this 3-month time scale. So this is the area in which we'll care about prices and the potential technical signals. We'll get through this in the second part of that video. This is just an introduction. Okay? So 3 months is going to be an area in which risk is going to probably outperform the yields. So at that point, if I decided not to get in because I didn't have sustainable enough reward for my risk taking, then I'll eventually consider doing it right after the 3-month period, when the risk will start decreasing, and only if I have a yield that is approximately 10%. Or higher, of course. So that's going to be my ground limitation to get in at approximately 3 months. If I don't have that, meaning that if the yields is below 10% because too many people are stacking, I'm not going to get in. And then comes another period, approximately 1 year late, surrounding this area. I'm questioning, but I think at that point, that depends on the first 2 phases. I'm going to have to readjust, but I expect I'm willing to get at least 6 to 7% yield to get in. Okay, and normally at the point reaching out the final stage, which is getting closer to the actual fully transitional, fully functional stuff, there's going to be a final risk management to make, not over technical risks, but over the fact that as we get closer to the expiration date, meaning people will be able to release their coins, they will probably do it because of, as your gains are locked into your stacking account, if you want to take those risks because you paid for your electricity and stuff like that, you want to pay for your bills, you want to take your gains, people will probably ask out right after the possible 2 years time date release being possible. So at that point, there's probably going to be anticipation of bearish demand, people wanting to profit take. Though that depends on multiple factors, how many stackers are there, how many gains they've made, and what are their profile. And we're going to talk about that much later on time, so I'm not even talking about this one, okay? What matters to me is, first of all, when do I enter? Okay, so these timings are a few days after if I get at least 15% reward to stake, or approximately 3-month period of lifetime, and I'll deal with the potential problems. And I want to have approximately at that point, I estimate 10% yields to get there at that point, and finally 6 to 7 if it is waiting over a year to get in. Okay, once you're in, you can't go out, so you're going to have to risk manage. So if I decide to go in over the 72 hours, I'm going to have to risk manage the 3-month period probabilities of having problems. And then I'm going to have to risk manage the probabilities of around 1 year time experience to have some underlying problems as well. These are anticipation because of statistical structure of risk measurement through a transitional system, okay? And I'm going to use that to provide more additional information. And today, before going any further, we're going to talk about who's going to be able to do it, who's not going to be able to do it. Though, if you have your personal node having 32 ethers or more than that, definitely, I think not even a question, definitely worth it. More importantly, if you are a long-term investors of Ethereum, you definitely want to go there. It's like, do you want to have your Ethereums without reward, or do you want a reward? I definitely want a reward, so I'm going to get in. It's not even a question. The question is when and how am I going to cover the underlying risks of the fact that I'm not going to be able to go out until 2 years. Those who will not be able to do it because of their reward being limited, are the one they have less than 32 ethers. They're going to have to use stacking pools with rewards, like we've said, rounding and surrounding over long term, reaching out to 4%. So they have a limited growth potential, and they're going to have consistent costs over the fact that obviously the stacking pool is going to ask for a percentage of your gains, but they're probably going to ask for a minimum deposit. So this is the first thing. Secondly, if you do it at home, and meaning that you have at least 32 ethers, then, I mean, the electric bills compared to the yieldings we could make, fuck it. We don't really have a big problem. These are negligible costs, unless electrical prices tend to multiply by 10. Otherwise, we should be fine. What matters is the initial investment cost, which means if you already have hardware, like for example, you were a miner or stuff like that, you goddamn have more than enough hardware to handle this node with pure efficiency. So don't even think about it. Otherwise, you've got plenty of guys who've been making hardware reviews on testnet of the beacon chain, and apparently the hardware stuff doesn't cost that much. But of course, if you are very limited in capital, then that can be kind of an expense. But finally, the most important thing is that we're going to have a big variable. Variable number 3 is going to be the Ethereum's price uncertainty biases, in which people will get to risk manage the things I've just told you about, because of course, I'll do it, which means the smart money will do exactly the same. And price will oscillate because of this. Both the anticipations of user growth, because of course, the higher the user growth, the higher the Ethereum's price will be, and it can turn to be pretty parabolic at some point. But when we'll reach those crystal areas of risk in which the risk will increase and at some point even overperform the potential yieldings, people will get to jump into cover trades. If you do not, then you will be at risk, and those who cover this risk will simply do their job. So there will definitely be professionals out there who's going to risk manage this thing, and I'm going to tell you how they do it, because that is my job. Okay, so now we'll get to price and we'll get to study this, but first and foremost, you get to understand this final thing. What matters for a risk manager is to understand that the risk isn't a constant. It's not something that you go on or out, you go in or out. It's not you're in, you're locked, though you cannot manage that risk. This risk is going to be by definition oscillatory, because at some point the yieldings will be higher than the underlying risk probabilities, though you will truly make profits without taking too much risk to get that profits. And when we're talking about 10 or 15% yield over a year, that's pretty freakingly rewarding. But there are some points in which technical risks of problems during the transition might be overwhelming the potential reward. And in these cases, which are time-limited offers, we might want to think about cover trades. Okay? Though now it is an appropriate time to get to talk about how we manage that risk using Ethereum cover price. I'm talking about short selling the Ethereum as you own them. You own 32 or more or less than that, and you're gonna have to sell either the entire amount, selling 32 to cover the entire position, which means if you own 32 ethers and you short sell for an amount of 32 ethers, you basically are totally out, which means whatever the fuck happens with price is none of your concern. If this happens, means you have a clear evidence that problems should be down the corner, that there is a risk for you to lose all the initial investment. So what we care about is that we're going to risk manage, like using this as a reference to our cover trades. At some point, we're going to modulate. The position side for short coverage of your portfolio are going to be the higher few days after the initial investment, after your entry into the blockchain, if you decide to do it within the first few days or first week, okay? This is where you might want to cover up to 100% of what you own if there is really problems emerging, okay? Now, if we get to the third month exposition, we're going to have to probably cover for 75% portfolio because the risk will still be quite high. But of course, these things will have to be adjusted. I'm just giving you kind of a roadmap out there. Things will have to be adjusted. And I expect that we're going to need no more than 50% the exposition coverage over 1 year exposition. You need to understand that, therefore, going short selling is a cost by itself. So you need to have available cash pool to short sell because that requires margin requirements and stuff like that. So you need to have capital available, and this is going to be a cost because there is financial cost over time for these cover trades, and this will be acted as a loss. You're not trading to make money with these cover trades. You might be if you're really good at it, but the goal in here is to really handle the risks of going wrong with the transition, because if it does well, you're going to make some money. That's just as simple as that. The gain in here is just you succeeding the transition without taking the risk of either losing it all if it doesn't work appropriately or just making a shit ton of money. There's a lot of in between, and that is what we talk about. Now that this is said, let's switch to the charts. This is the fully important part of it. Okay, so what you have in front of you in here is an Ethereum chart of a weekly time frame based stuff. And we're going to start right here, right now, as we're getting closer to this introduction. What are the technical signals we have right now? And where are we, technically speaking? We are nearing the 600 area, and we do have some signals that stability might be there. In terms of technical risk limitation, I'm going real fast in here. This is technical job, and if you want to understand all about it, you've got plenty of other videos on this YouTube channel, but I definitely just can't make you a course over risk limitations and risk managements, because that would take far more than the 30 minutes I wish I will take out there. So in here, we're definitely into a risk management area right now. So that definitely means that investors are managing the risks, and you can be damn sure about it. So we are pretty much at intermediate areas. And like I said, the potential volatility over emergence of the contracts will be at its highest few days after. So I suspect in here the volatility could go right up to the next resistance, which is around $900, precisely 828. What I'll care about is what are the signals I'll get out there to eventually cover for the risk, because if the price increases, I would definitely consider short selling partially the Ethereums I own, whether they are stacked or not. Because I'm not going to sell my Ethereums, I will put them into a node. So even if I enter or do not, I will cover for the potential loss of value they could have in between. So this is my next tradable area. If we get there, I know I'm going to be doing something. Then I also have to risk manage the probability of failure, because if it fails, we're going to have downside volatility instead. So I need to risk manage these probabilities at the moment. And let me be clear regarding the underlying signals I have. I can see that this is not that bad, and I suspect price might be going these areas, pretty much likely the higher one than the lower one. Of course, I don't know, which means right before the ignition of the beacon chain, I will definitely have to partially cover the portfolio. And if prices drop, I will make money to compensate for the asset value that drops. But like I said, to me, the ignition is very less likely going to destroy the blockchain. It can create a problem that will very likely going to be hot fixed a few days later. So it's not a matter of life or death in here. So I'm not covering for Ethereum going from 500 to 0 in just a few days. It's simply not possible. Okay? The death of Ethereum could show up far later down the process if people see too much problem and some competitors outweight the cost. And in that perspective, all of the users will switch to another blockchain, which will be absolutely catastrophic for Ethereum. But right now, at the ignition, probabilities for this thing to totally blow up and to lose all credibility, close to 0. So it can go 0. So it is personally, and that's the reason why I think we're pretty well settled right now, the risk to go right up there and the risk to go down there. So as you can see, we're sitting pretty much right in between. And what happens in here in terms of volatility depends mostly on information-driven stuff, which you don't know anything about. So if you're willing to take that volatility, which I personally am, I don't give a shit. I'm eventually going to cover my trades, but only if we get to the interesting area, which means if we get there, the probability for downside effects will be significant enough for me to cover my trades. So if it goes down, I don't give a shit. I'm going to wait over time for things to be solved and to move on to the next area. If prices drop, I'm not going to get in, and I'm going to wait for the next timing of 3 months and decide if I want to get in or out. That depends mostly, like I said, on the yieldings I get and the price movement. If price recovered at 3 months after the initial volatile period, I'm definitely going to get into the Bitcoin chain. Okay? So for the initial trade, I'm not going to cover for this trade because the risks of totally wrecking the system is very low. But still, if we get to some higher prices, I'll consider covering my trades. Just for the case of purposes of things could do great the first day and 72 hours later, bam, there is a problem and I want to cover for this. So if I get nice trade prices in here, I will cover partially the portfolio. I'm not going to cover 100% of my Ethereums, but probably 50%. Then, after this first day initial period in which it's just going to be volatility and dumb traders putting some stupid trades out there, I'm not willing to do any arbitrage unless we go to a resistance. That's the reason why if Ethereums go there right after the ignition, you can be damn sure that the smart money is going to do exactly the same as I do. Either they're going to protect the resistance by short selling it, or they're going to wait to break it to short sell right after. But they're going to cover for their exposition. As they will get in the Bitcoin chain, they will have to cover for the risks of potential downside effects. Simple as that. If you understand it, that's real great. Moving on, because that's not the most important thing, because I personally assess the probability of me entering the blockchain on the first week is very low. I would say 30 to 35%, and that mostly depends on how good the yield is and how volatile the price reaction is for the first days. So if I get in, or even if I don't, the next step is around 3 months. And around 3 months, if I have sustainable yieldings, I'll get in and I'll have to cover for the potential underlying risks. And therefore, I suspect that this area, if things do great, should probably be consisting to the next tradable area, this one. Okay, though I'm talking about potential problem at the Bitcoin chain ignition, but normally things should be solved or hot fixed, and then price should normally increase as the demand is maintained. That is, of course, if the demand is maintained, meaning people don't live out of Ethereum because of these problems and fear. If confidence in the blockchain is still there, price should increase because of growth in demand. Simple as that. This is the area, technical area, that I generally use. I can hardly explain you why, but this is generally an extension of 138 or 127% of the previous range, which is an area of technical risk limitation for professionals. So if everything goes great for the first ignition and launch, we should get there over 3 months or 6 months. That depends on how volatile and stuff like that. There is an intermediate area right below the market top, of course. If we were going real low after the launch, then we're eventually going to have to switch this risk limitation area to the 76% cluster Fibonacci, which is 1100. Okay, so this area, depending on how strong the price and the volatility is, that depends on how much problem we have with the volatility in the beginning. And of course, if we shit the thing, then we'll get lower. Okay. But these are the areas I'll care about. Risk limiting around 1100 or risk limiting around 1900, depending on the appropriate timings. These are the price I will short sell no matter what. What the amount of short selling is going to be regarding how close to the timings we've talked about we are. If we're surrounding the 3 months lifetime, surrounding prices trading closer to the 1100 area, and I have some short signals, some risk limitation signals, I'll definitely cover the portfolio. How much will depend on what signals I have, but I suspect something between 50 or 75% in a worst case scenario down to 25 if I have very limited signals. Okay, these cover trades are not intended to make money. They're just intended to cover the portfolio for underlying risk, which means I'm going to short sell, keep the position open as long as the risk period is still there. I'm not necessarily going to try making gains over profit taking on support. But let me be honest, I probably will do that. But you shouldn't. These cover trades are really there to cover your exposition to the upside. If you do some arbitrage with those cover trades, it means you really know what you're fucking doing. And that means you're experienced enough to do that shit, which I doubt you guys, most of you guys are. All right, so don't try to make money with the cover trades. They're there to cover the risk that you can't go out without 2 years. So if you make money in the first stages and end up losing it all because there is a death kind of trap problem, then you're still going to have made that money because you have covered the portfolio and you're not going to exit totally naked. You'll probably lose the initial investment that will be locked for 2 years, but you'll still make the nice gain for your cover trades. Though you just don't go out with a simple, stupid, bullish or bearish answer of either I'm going to be rich or broken. That's not how things work in trading. There's a lot of shaded gray area in between. Okay, so these are the technical area for the second 3 to 6 month period of risk, technical risk that will emerge, either 1800 or 1100, sorry, or 1800 as an area. I doubt we could be anywhere higher than that until that period of time. Okay, then comes the 1 year old period, and like I said, this area depends on the timing. This is the same area as previously, but this one is simply not reachable by the 3 months or 6 months, or very less likely going to. Could be reached out to if things do well or not that bad over a year. Of course, that means this is fairly positive. Prices will be 5 times what they are right now, which means we flushed out so most of the risks of problems with the transitions, still some problems, of course. And in that perspective, if we get into this area around the year, I'll definitely look at the potential signals to define how much cover trade I'm going to be taking. Same old thinking process, okay? In this area, I suspect same thing for covering 2/3 of the position, 66% down to probably just 25 if the signals are really low risks, okay? So this is all about it. The better the signals I get into those speculative areas, the stronger the cover trades I'll take. When am I going to trigger those trades? Only if they get into the speculative area around the timings I just talked about. I'm looking for time-based clusters and risk clusters because normally people who do well will anticipate that risk. Which means if we get closer to those danger areas with attractive speculative prices surrounding these either 3 months or 1 year old blockchain transition, this is where smart money will risk manage. I'll tell you this in advance. I don't know for sure because I don't know the future, but this is the roadmap most of professional traders will have. Of course, we'll have to readjust as time passes on and how complicated the underlying problem were. But if everything goes fine, this is my roadmap. I'm going to readjust, of course, and I'll let you know into the channel, of course, because like I said, my choice is made. Am I going to stack my Ethereums? God damn, yes, this is not even a question to me. I buy and hold this currency, but that doesn't mean I want to end up with either losing all the value or making a billionaire of myself. That's not really all about it. It's really stupid to think it that way. Stop thinking about Lambo stuff or getting broken. Don't bet. Try to be a trader, and a trader never has just one outcome. I'm definitely not invested just into cryptocurrencies, and either these things worth $1 billion or worth nothing for me, I don't nearly give a shit. All I care about is if it has the worth $1 billion, I definitely want to go down this road without taking too much risks, which means I will intermediately risk manage my probabilities. And if this thing is just a piece of crap that worth $0, I still want to take some money out of it, and short selling is the way I'll do it. Okay? So it's all about risk managing the probabilities of you being right or wrong without ever going black or white. It's not about short selling the entire amount you own. I doubt this is. That would be absolutely stupid and very costly in terms of margin expositions. That's all about it. So try to think as a trader, as a shaded gray area. Have yourself a roadmap, because every trader will have. Think that anyway, if that is your plan, it's not necessarily gonna act exactly that way. But if you have no plan, you're gonna act upon feelings and stuff like that. That's the worst possible case. So have a goddamn plan, make it rational. Okay, so if I had to make one of a recap of what's just been said out there, because there's plenty of information to process, the beginning of our thought process was that so many guys out there have done a pretty damn good job talking about the technical stuff of how to get into stocking and stuff like that, of the underlying potential risks and costs. All of those things have been pretty well settled out there. This is why I didn't go into too much details out there. But I wanted to add some kind of a professional risk management vision to this because I've never seen anyone doing it well out there. And I really want to add up my personal value on this, hoping that you'll get valuable information out of this. What you needed to process out there is that professional traders or those who have significant enough funds, they'll not get in as people think they are. They're not going bold either in or out. They're definitely not going to risk losing millions of dollars of value by getting into something they cannot exit for 2 years. They definitely have a backup plan. The backup plan is they will use short cover trades to risk manage. And they will probably do it the way I do, because that's what every risk manager does. They take a reference scheme in which they adapt and predict. And they will probably use the one I just told you about, which is assessing the high risks and high potential of volatility within the first day, and either making some real short-term arbitrage. They're probably not going to do anything the first day unless there is a serious problem, or unless prices are attractive enough. That's the reason why the 900 area is definitely an area of interest. And if we get there, you can be damn sure that whether it does well or not, I'm going to short sell this area. Just how much is the only variable out there. Am I going to short sell 900? I will, but I'm not going to be net seller. You need to understand that short selling isn't stupidly being bullish or bearish. It means I own some coins. I'm going to short sell part of it, which will reduce my exposition to this market and to its volatility. Okay, that's just as simple as it is. It is a risk limitation action, not a dumb betting on bullish or bearish, which many people think it is. Okay, it's a lot more complicated than that, and a professional knows that. So they will do it as well. You can be damn sure they will. All of the next technical areas in which price will be interesting are the previous 75% retracement, which is closer to $900, now $1,000, if my memory is right. No, sorry, 1,100. Okay, the next area is on top of the resistance. We know the all-time highs, which is surrounding 1,300, if my memory is right. Then we get an area at 2.5K, and all of these areas, if they're met with the approximate timing we just talked about, few days, they're not likely going to be at $2,000, I doubt it. But okay, over time, 3 months approximate timing, okay, or 1 year, if you get into this timing, you know that those areas will likely react. And you'll simply take the closest area. If we get to 6 months and are already at 1,100, then you know that there will be risk limitation going nearby because of both the rising risk of shit to show up around in 3 months and the interesting price to risk manage this. That's what a professional will do. They will do and act out there. How do I know? I don't know for sure. I'm not going to trade without signals. And how much cover trades I'm going to be taking depends on the signals I get. Why? Simply because no one knows what to do, and we're all watching someone else's ass to figure out how much the risk really is. So I don't know personally what the risk is going to be, but the market is supposed to figure it out, though the market signals I'll get into those speculative areas will tell me what to do. So do I know now? No, I don't. I'll act according to what I'll get at the moment. I just have a roadmap, and that is the significant difference than people who get out there unprepared. That also means you're going to have to prepare with the fundings. You need to have a funded account with enough money in there to cover for the margin trades up to eventually going 100% short selling, which means if they're really big shit down the corner, I think it's very less likely going to be, but if it turns out to be a matter of life and death, you must be ready to short sell the entire amount you have, getting 10 entirely out the market. Doing this will not turn you into a bear trader. That will just turn you into a trader out of the market, which means whatever the value is when you take your short trade, let's assess you short sell at $400, then that means no matter how many coins you have secured $400 value. And whatever happens next is if it goes up, you're going to lose money. If it goes down, you're not going to lose money. That's just as simple as it is. You're out. When I say lose money, I say lose gains, which means as you are covered, if prices increase, you're not going to profit from it because the gains you make with your coins, you lose it with the value of your short selling. I mean, you kind of get the point. So if you don't understand anything of what I just said, you really need to learn about trading. Otherwise, and just the basics is you're going to understand that things will oscillate, and they'll oscillate both across technical areas and precise timings. You can anticipate those timings and those areas to be the one I just told you about. And if you just understand all of it and get prepared for it, I see absolutely no reasons for you not to make money with stackings, because if you well manage the risks, then they're just gains to take. Because even if it turns bad, you're still going to make money. The question is, how much can we take out of this blockchain if shit really hits the fan? And if things do well, we're inevitably going to make money. The question is not how of a billionaire we would be back there, down there, but more importantly, how did we process the way to this? I goddamn hope it's going to be successful, otherwise I wouldn't get in, though I think it's going to work out, but I know it's not going to be a peaceful transition. There will be intermediate risk limitation, and you have to understand that the market will anticipate them. Smart investors are not going to wait for the shit to eventually hit the fan. They will anticipate, and they will anticipate surrounding the cluster that I told you about, the time clusters and the price clusters. Okay? If you get that, you're really, really getting much better than all of the guys that will go out there naked and end up with a binary outcome. They want to be billionaires or lose it all. That's absolutely stupid, and that's not how risk managers and wealthy investors will do. They will do the way I do. I can be damn sure about it. That being said, I'm going to give you guys kind of a quick recap out there, and I'm going to leave you with that. So that's as simple as it is. This video is not sponsored by any fucking thing like many people do out there. There is absolutely going to be no ads and stuff like that. This is totally ad-free. I'm doing it for free. I don't have anything to gain out of this, but just to inform you. So if you wish, and if you looked at that video till the end, I could have somehow asked you if you can give me at least a positive thumb. That will help spreading out the word out there, because of course, as this thing is not monetized, that means I'm not publicly pushed to other users. Only you can help this content be visible for the others. So thank you for your time. Thank you for your support if you do want to. If you didn't like, you're free to go for a negative thumb, of course. No worries with that. See you guys later, and hope you will be successful with this transition, or at least you'll do it well in between. Bye guys.